Hi, this is Jack Duvall, CEO of Bantam Incorporated, a private investment office in New York. Today's video is another in our investing series, and I want to talk today about something that I think is on everybody's mind, which is how do you invest in this crazy market in which no one has any confidence? Nobody has any confidence in this market because it's artificial. It's artificial in the sense that, not in the sense that the prices aren't right. No, the prices are high and they've gone up quite a bit, but it's artificial in the sense that it's driven by central bank liquidity and extraordinary treasury measures of just handing out money to people. So it has rendered the traditional kind of economic and financial analysis irrelevant, basically. And people who are just, value investors and things like that, they have had nothing to do. Warren Buffett's sitting on $130 billion in cash because the prices are insane. And no matter what your favorite metric is, they're all insane. But the market continues to march higher. So how do you invest in this market? And this is something that I've struggled with. And I'll tell you what we do. The first thing is always risk control comes first. That's always true, whether market's going up, down, or sideways. Everything else comes after that, but you've got to be focused on risk. It is painful if you miss upside in the market. Believe me, I know. But that pain is nothing like if the market goes down and your assets go down, 30, 40, 50%. That's extraordinarily painful and very difficult to come back from. The investment math is very simple. If your assets go down 50%, you need a 100% return just to get back to even. And obviously 100% returns don't grow on trees. It takes years to make it back. So here's what we do. First thing is when we're investing for a client, we liability match the assets. And I've got a blog post out on that, and I've got a video out on that. You should watch it. Very simple. You just match up when are you going to need the money, and you match investments to that. So if you need money, in the short term, that money's in cash. If you need money a few years out, that money's in bonds. It's only with the, kind of unencumbered or unmatched assets that you really want to take risk with. So that's the first step. You liability match the assets. The second step is at least what we do is we split the assets and literally we put them in different accounts. One is the conservative fixed income account and the other account is the risk assets account. So there's a very clean delineation between the accounts and what the mandates are for each account. And in that conservative fixed income account, that account's not going to experience wide fluctuations. Could go up and down some, no doubt about it. But you're not going to see, a 10% decline in that account unless something absolutely extraordinary happened, like, the U.S. government went bankrupt and defaulted on all its debts or something crazy. That would never happen because they would just print money. They're not going to not pay their debts when you have a printing press. And then you've got the other side, the risk assets, and that's where you're going to take your risk. But the way we do it, that account could be 100% in cash. It does not have to be fully invested all the time. We're under no mandate to keep that invested all the time. But if we're going to take risk, that's where we're going to do it. So it's very easy to follow and to manage. The next thing is to eliminate complexity. And I've written about this. I have a white paper out that you can find on the blog post or on the website. And I've done blog posts about complexity. And you can go check that out. I also have a video on complexity. You really want to eliminate complexity because that's where surprises lurk. And they're always to the downside. You never have a complex investment that went up 5x when you thought it was going to go up 5%. It's the other way around. You thought it was going to go up 5% and it went down 50. That's the kind of surprise you get from complex investments. And the last thing I'll just say is in this environment where we're in a zero confidence, at least stock market, if you're in the stock market, you must keep tight stops on your positions. You cannot have your equity investments turn into investments at the top. And, you turn, as they say, you're a trader, but then the position goes against you and you turn into an investor. If you're going to do that, I think there's real potential for a lot of downside. Who knows? Because we are completely in uncharted territory. But again, if you look at any of the historic benchmarks and how extended we are and how many standard deviations we are from normal and all the valuation metrics, we're completely untethered from reality. Could continue for 5 more years. I have no idea. But you don't want to stick around when it goes, because when it goes, it'll be bad. So those are some thoughts on controlling risk in your portfolio. I hope that's been helpful. Jack Duvall, thank you for listening.